So here we are, halfway through the year, and let me ask you this. Are you really on track to minimize your tax burden, or are you on a fast track to another unexpected bill from the IRS? Today, I'm going to give you powerful strategies that every small business owner should be looking at, especially mid-year, not at the end of the year when it's too late. Whether you're trying to save thousands or just want some peace of mind heading into the second half of the year, this episode will help you take control of your tax plan now, not after the damage is already done. So why does this matter now? Because once the year ends, most strategies are off the table. And now is the time to start looking into those strategies and what you need to implement. So let's dig into it. The first thing that I kind of want to walk through is to encourage an entity review. Let's look at everything that's going on in your business and understand kind of where are we at with different things. You know, do you have an LLC structure set up? Do you have an S corporation structure set up? Do you need those set up? And so this is a really good time to say, okay, where have we been so far this year? Because a lot of times I talk to people and we talk about S Corps, LLCs, all different times on our YouTube channel, our podcast. So definitely go check out where we deep dive into those. But an S corporation can be a super powerful strategy to help minimize the amount that small business owners pay in self-employment taxes. But we don't want to rush into an S Corp structure before we're ready for it. But we also don't want to miss out on that opportunity if we are ready for it or if we're going to be ready for it. So this is a great time to do an entity review. If you have multiple businesses, do you have those organized in the most tax efficient way with a holding company? It might be an S corporation with DBAs or single member LLCs or partnerships underneath it that all flow through to that one holding company. Or do you have rental properties and are those structured separately from your operation companies? And this is a great time to do an entity review just to see where you're at. And one thing, we kind of talk about this idea of an S corporation. If you don't know what an S corporation, we have plenty of content to check out on that. But one thing about an S corporation is that in order to have an S corporation, you need to have an LLC or a corporation set up. So let's say that you are starting your business, you didn't expect it to really grow much this year, and so you're just running as a sole proprietorship, but then you land a big deal and you get all this money in for it, and you're like, oh, okay, Mike, I want to be an S corporation. Well, the problem with that is you're running as a sole proprietorship. So that big chunk of money that you just got, there's nothing we can do with that from a self-employment tax savings because it's stuck in a sole proprietorship. But what happened if you have an LLC set up? An LLC could be set up without an S corporation. We don't need to do an S corporation right away on an LLC, but we can have an LLC set up that's going to have some legal protections that's going to be good there. But that LLC can be set up as sort of an insurance policy to say that if our business grows to a point where we want to do an S corporation, we can do a back S corp election and backdate it to the beginning of the year. And so I always encourage business owners, once you have, if you're just in that super early idea stage and saying, hey, I want to be a business owner, not really sure what I'm going to do or where it's going to go yet, but I just want to be a business owner, sole proprietorship's fine. But once you start to generate some income and you have a real business idea, I always say everyone should have an LLC set up. Not only for the legal protections, talk to an attorney about where that can be super powerful, but now once you have that LLC set up, it serves as your insurance policy. You don't need to do an S corporation until you start to say hit $50,000, $60,000 or more in annual income or profit from your business. That's when we want to start looking at an S corporation. So we don't need to rush into that S corporation, but by having that LLC set up, it allows us to go back and backdate an S corporation if we start to grow our business significantly, even if it's unexpected. So now is a great time to do an entity review. Do you have an LLC set up? Is it time to start looking at an S corporation? Are you expecting $50,000, $60,000 or more in profit from your business this year? Should we start looking into an S corporation? Now's the time to do it. We don't want to be doing this in December. That's for sure. Are you getting into new rental properties or getting into other businesses here? Do we need to start looking at what type of entity structure do we need to have for that? Or do you have multiple businesses that you own and say, how do I organize all of that into a very tax efficient vehicle for all of those businesses to succeed? Now's a great time to start that review. The next piece I want to encourage, especially in tax year, is in the mid-year, is to start to learn tax strategies and implement them. And by watching this exact video, you're in a great spot. You're taking that first step to start to learn, and that's an important thing. We have podcast episodes, we have YouTube videos, we have my Small Business Tax Savings Handbook, a book that you can find on Amazon. Go purchase it right now. Small Business Tax Savings Handbook that has a ton of tax strategies in it. We have our software TaxElm. There is a lot of opportunities out there to learn, and so we need to start to learn because guess what? I talk about this all the time. The government, the tax strategies that we utilize and we implement and we encourage business owners to implement are in the tax code. And they're in the tax code for a reason. They're in the tax code because the government wants something and they can't do it themselves. Let's look at, for real estate investors, affordable housing. The government wants us to continue to build affordable housing for the US citizens to be able to live in a reasonable rate. But the government's not going to go out and start building apartment complexes all left and right. So what do? They implement tax policies that encourages their citizens to go out and build affordable housing. By building that affordable housing, we're providing housing for the citizens. And what is incentivizing me as an investor to build affordable housing? Tax breaks. The government encourages that. The government wants us to grow our economy. The government wants their citizens to be employed. So how do they do that? They give tax breaks. They get tax incentives for people to be business owners. Because as a business owner, you're going to start to employ people. And when you employ people, those people go out and buy things. Those people are employed. Those people go out and buy houses. They go out and buy different things for their family. That is a good thing that the government wants. And so how do they encourage people to be business owners? They create tax incentives for them. And so it's our job. Now, here's one thing. The government doesn't go out and put these tax incentives out on billboards, and they don't come knocking at your door if you don't take advantage of it. They don't say, hey, you forgot to hire your kids or you forgot to use the home office deduction. The government doesn't do that. They put it in the tax code for you to learn it, understand it, and implement on your end, but they're not going to come knocking if you forgot to implement it. And so that's where it's your job as a business owner to understand what strategies are available to you, and then not only just learn, but implement them. And not just implement them, but correctly implement them. And that's what I always say about implementation. If we look at the home office deduction, for an example, this is black and white in the tax code. Everybody should be taking advantage of this, especially if you qualify. It's black and white in the tax code, but you can take something that's black and white, is written there, it's encouraged. You can take something that's there and make it illegal by just incorrect implementation. So as we're learning these strategies, that's good. But learning doesn't provide tax savings. The implementation and the correct implementation provides tax savings. And so have you taken the time yet? Have you taken that time to start learning? Now is a great time to do it. We still have plenty of time. Again, we don't want to be learning tax strategies in November, December. That's almost too late. And once 12/31 hits, most of these strategies get thrown out the door. The next thing I want to encourage you to do is check in. How is your business doing? Where's your income at? What is your income going to look at for this year? What tax bracket are you going to be in? Are you pushing into another tax bracket that income might start becoming taxed at higher amounts? Or are you really low in a tax bracket? Are you going to have a down year? Maybe that opens up the door for some Roth conversions or opportunities to do different things. So do a check-in. Estimate kind of, okay, we're mid-year. Here's the income. Here's all these different sources that have income coming in. Where are you going to be? Where are you going to be on the tax bracket? And is there planning that you can do within that specific tax bracket? Is there things that we can do to help lower our tax bill and to do specific planning for that tax bracket? You know, if we look at business owners, there's this QBI, qualified business income deduction, where you get a deduction of 20% of the profit of your business. So you make $100,000 a year, you pay taxes on 80 because you get a 20% deduction. But depending on your business type and as income increases, that deduction can start to phase out. But if you're starting to get into that phase out range, we can do planning, different strategies, different investments, different tax things to help bring you back into that phase out phase. So that's where understanding where you're at is super critical when we look at tax planning, because there might be specific planning that we want to do around your tax bracket or around different and various phase out limits across the board. So that is a great time. Now is a great time to kind of line up where you at in your business so far this year. The next concept I want to talk about is this idea of maximizing deductions. And we talk about this all the time on our podcast and our YouTube channel. But this idea of maximizing deductions is a mindset shift. It's something that we need to be thinking about and doing all year long, because once you hear it, once you learn about what I'm going to talk about, you're like, oh, here's an opportunity. Oh, there's an opportunity. And guess what? If you learn about this concept in December and start implementing it in December, you missed out on January through November to take this concept and put it into practice in there. And this concept is after-tax spending versus pre-tax spending. And to give you a really quick and brief example, if you're a W-2 employee working for somebody else, you have gross wages, your employer takes all these taxes out for you, and then you get your take-home pay. And you go out and spend all your money on that using that take-home pay. You have a home, you're paying for that. You have an automobile, you're paying for that. You're buying groceries, you're paying for your kids' stuff. You're doing all these different things using take-home pay. And that take-home pay is what I call after-tax spending. That money's already been taxed. But as a business owner, you have your sales or gross revenue, and then you have these expenses that offset that sales or gross revenue, which eventually leads to the profit in your business. And you get taxed on the profit of your business. So any spending that is done inside of the business is considered pre-tax spending. That's spending that's done prior to the money being taxed. And we want to have pre-tax spending versus after-tax spending. And so how do we do that? That's a mindset shift to say, how do we take something that I'm already going to do that we're doing using after-tax dollars for, how do I turn that into a valid business deduction and turn it into pre-tax spending? That's that kind of mindset shift that we need to make. And this is super important and super clear to help understand where those opportunities exist. Now, a lot of people, when they think tax planning and maximizing deductions, they think I'm going to go buy a vehicle that I don't need, or I'm going to buy a piece of equipment that don't need because I'm going to get a tax deduction for it. And that's not what we're talking about here. We're saying we don't need to spend anything more. We can take the spending that we're already doing, but now we can take it and move it from after-tax spending into pre-tax spending if we do it correctly. And so things like this are meals and travel. So think of meals. We're always talking about our business. Whether you're meeting with a friend or a family member, if you're talking business, that's could be considered a valid business meal. So think about meals a little bit differently when you're doing that. Travel. Me and my wife used to do this all the time, especially before we had kids. We'd say, and we had this opportunity where a trip we wanted to go see Washington, D.C. I've never been there. She's been there, but we wanted to go together, and we wanted to explore the city, do the museums, go to the Capitol, do all those fun things in the city. And that's all sounds great. That's all personal expenses, right? But what if we found a conference, or what if we found a vendor, or what if we found a client that we could spend the majority of those days out there doing business items? We could go to a conference from 8 in the morning to 1 in the afternoon. That's considered a business day. That full day is now considered a business day because the majority of the day, more than 4 hours and 1 minute, was spent on business. The majority of that day was spent on business. The IRS doesn't care what we do after that. We go explore the city, do meals, we stay up till midnight, we do all these fun things. That's still a business day. So now we just travel. Place that we wanted to go anyways, but instead of using after-tax dollars for it, we used pre-tax dollars for it because we found a business purpose for that travel. Board meetings is another example. Every business, whether you're a solo business owner or you have 300 employees, every business should have regular board meetings that lets you step away, that lets you talk to people that are close to you. Maybe it's family members, maybe it's spouse, maybe it's children, parents, maybe it's friends, maybe it's an advisor that you really look up to that can help you. We want to set up a board for every business out there, whether how big or how small. We want to set up a board that you can meet on a regular basis to get advice for your business. But not only that, guess what? Those board meetings, tax deductible. You might be renting out a board room for this. You might have meals associated with that. You might have some travel every once in a while for some of those board meetings associated with that. Guess what? Tax deductible. And maybe your board's family and friends. And you're going to these events and you're hosting these board meetings with family and friends. Now you're getting a business deduction for that. Some of those things, people that you want to hang out with anyways. We also love to combo this with the 14-day home rental rule. And that rule just says basically if you rent out your home for 14 days or less, you don't pay any taxes on that income. That's a great thing. But most people don't have an opportunity or reason to rent out their home for 14 days or less. Well, what if we hosted some of those board meetings in your home and paid a reasonable rental rate that you'd pay to rent out a boardroom anywhere else to your business, from your business to your personal account? Now you get a business deduction and you pay no income taxes on that. If done right, that can be super powerful. Hiring your kids. This is a great example. I say everyone with kids, roughly 7 or older, should be hiring your kids in some way in your business. Now your kids need to be doing actual work and you need to be paying them a reasonable rate, and there's a lot of dotting your I's and crossing your T's you can do. But by hiring your minor kids in your business, you get a business deduction and they pay no income taxes on that. Again, we're paying for things. We're paying for basketball camps. We're paying for amusement parks. We're paying for all these things for our kids. I'm a father. I know how much kids can be, but we're using after-tax dollars for all that. But what if we can hire our kids to do legitimate work in our business and pay them a reasonable rate? Now we're getting a business deduction in that basketball camp. They go and pay for. That's a quick move of moving after-tax spending into pre-tax spending. That can be super powerful. Again, we have all sorts of content around on this. Automobile or home office. Again, automobile, Every business owner should have some type of automobile expense on their item. This could be an automobile that you use personally that you just reimburse yourself for the business use for it, or a home office. Think of a home. You're going to have a home no matter what. Whether you're a business owner or not, you're going to have a home, you're going to have those costs. But instead of having 100% of those costs be after-tax spending, why not take advantage of the code that's available to us and take the business use and turn a portion of that, maybe it's 10%, maybe it's 7.5%, whatever it might be, but a portion of those expenses we move from after-tax spending into pre-tax spending. That's the power of this concept. Now, if you're an S corporation owner, that we definitely will be taking advantage of this, but you need to set up an accountable plan to do this. An accountable plan is a fancy way to reimburse employees, which as an S corp owner, you are an employee, reimburse employees for items that they paid for personally. Think personal use of an automobile, think home office. So there's a lot of planning there. If we look at health-related strategies, if you have high medical costs, there's different strategies that we can implement where you can get a business deduction for those health costs. Boom. Think of the power behind that. A health savings account. I think everybody should be maxing out a health savings account every year if you qualify. If you're self-employed and you're paying for health insurance, that's a business deduction. You just got to make sure you're doing it right. So with all these different things, we need to make sure that we understand this concept and say, we should be thinking every time we're swiping a card, every time we're spending money on something, is there a business purpose for this? Can I move it from after-tax spending into pre-tax spending? And I want you to take from this, that's something that I want you to be doing on a regular basis. Now, real quick, if this is all kind of piquing your interest and you're looking for tax strategies that you can actually implement, I built a software called TaxElm. We don't just show you how to save on taxes, we help you turn those strategies into real dollars saved with clear, step-by-step guidance and full implementation modules for every single strategy. If you're serious about paying the least amount of taxes legally possible this year, click the link in the description and book a free discovery call with our team. All right, now back to some of the mid-year check-in items. Retirement planning. This is a big one for business owners because you know what? As a business owner, sometimes we step away from retirement because we're so used to employers kind of just handling that for us. And I've seen so many business owners that just didn't put the time and effort because they, one, maybe thought that it was too much work, so they didn't do any type of retirement planning. But there's a lot of power there. There's a lot of things you can do in retirement planning. It all depends on how much do you want to put away towards retirement, and that's going to lead to the type of retirement plan we set up. Now, if you have no employees, you might be looking at a SEP IRA or a solo 401k, and especially if you want to max out, a solo 401k is going to be a great option. If you have employees, we might look at a simple IRA or a safe harbor 401k or just a regular 401k. But now is the time that you want to start thinking about this. If this is the year that you want to start thinking about retirement, now's the time to do it. Look at a SEP IRA or solo 401k if you have no employees. Look at a simple IRA or a 401k if you have employees. If you already have this set up, start to plan. How much money are we going to put into those this year? And you know, as a business owner, this is something I want to talk about. I would never had a retirement plan at the beginning because I thought that they were too expensive. They were too complex and they weren't necessary. And I only wanted to put away this amount. The thing is finding a retirement expert that knows what they're doing and understanding how much do you want to put away. If you want to put $5,000 away a year towards retirement, don't open up a business account, just fund a traditional or Roth IRA. If you want to put 15, 20, 30, 50, 100, 200, $300,000 away, now we're looking at retirement strategies. Now we're looking at different retirement plans and what can we stack on top of those and what can we do there. And the thing is open up a retirement account and manage a retirement account really isn't that expensive. And there are so many credits available right now that the government wants people to start retirement planning because, you know, this whole Social Security thing, everyone's worried about that. And so what the government wants to do is they want to say, hey, how do we make Social Security less of a concern? Let's encourage people to put money in their retirement accounts in addition to the Social Security that they can plan on for that. And their way to do that, the way to encourage people to put money into retirement accounts is to create credits, is to create tax incentives for that. And there's a lot of credits out there right now that will actually cover the employer contributions to a lot of these plans, cover the costs to open these plans, all sorts of fun things that we talk about there. I talked earlier about Roth conversions. Do you have money in traditional IRA accounts or traditional 401k accounts? Maybe you want to turn that traditional money into Roth money. If we look at your tax bracket, are you in a down year or do you have some losses from your business or maybe other investments? Is now maybe a good year to convert some of that traditional money into Roth money? You know, we did a podcast episode, a YouTube video on this. Check that out. Now is a great time to start analyzing. Does that make sense? Is now the right time for that? You know, we talk about estimated taxes. As you're kind of analyzing where your income is and also doing some planning, start to look at, And if you haven't already been paying estimated taxes, you're a little bit late to the game already, but start to look at how much am I expecting my tax bill to be, and let's start to make estimated tax payments towards that future tax bill that we expect. We talk about strategic investments. Now is the time that we might want to be thinking about some of those strategic investments. Do we want to invest in real estate? And part of that real estate, we want to be able to take advantage of the government's incentives. Oftentimes a lot of people will buy a rental property and they will be cash flowing, positive cash flowing, but paying no taxes on that due to depreciation and various other different things. You might want to look into investing in that. You might want to look into equipment or vehicles for your business. Again, I would never tell someone to go out and buy something you don't need for your business. But if you do need equipment, if you do need vehicles to operate your business, maybe we want to look at some strategic business investments, getting into those different things. I always recommend every business owner should have a capitalization policy in your business. That's something that you put on file that says, okay, if any expense is under this item, we're going to automatically expense right away, and we don't have to worry about depreciation or capitalizing or any of those different things. Over the amount, then we depreciate and capitalize. So everybody should have a capitalization policy in place that clearly defines that. There's a lot of, if you're selling an asset, if you're selling a highly appreciated asset, maybe it's a home, maybe it's a rental property, maybe it's a business or whatever it might be, we want to look at planning around that. If you're thinking about selling a highly appreciated asset, crypto, business, those different things, you want to start planning for the tax hit from that right now. Start thinking about that. Even if you're a year and a half out, let's start planning about what are some tax strategies that we want to talk about there. Now, a lot of what we talk about is what I call core tax strategies. Once we hit about $350,000 or more in income, we start to kind of dive into the ability where it opens up the door for some advanced type strategies. And advanced type strategies are a little bit more complex, but they can provide some huge impacts. And so now's a good time. If you're starting to get into that income limit, or you're starting to meet different thresholds and different things, you might want to look at some advanced type strategies. And that could be various asset purchases. Maybe you're getting into various asset purchases. We have deals where we talk about software purchases, and there's some tax advantages to that. Investing in solar, and what are some of the tax credits available to that, as well as some tax advantages of investing in solar that can help from a tax standpoint. So not only an investment standpoint to grow your money, but also a super tax advantage way. Maybe you're investing in film or various other different strategies and programs that we talk about within TaxElm that we help people walk through some of these advanced tax strategies. Maybe you're looking at a short-term rental. Short-term rentals have some really, really cool tax strategies around them where if you materially participate in it, you can use losses from a short-term rental utilizing a cost segregation study, and you can use those losses to offset W-2 income, business income, because a typical rental property, a long-term rental property, unless you qualify as a real estate professional, you can't use those losses to offset your other type of business or W-2 income. So some people might start looking into a short-term rental. Again, if this is a year you want to do a short-term rental, looking into buying that in November or December, not a good idea. Now's a great time to start thinking about that. We talk about various different charitable strategies and leverage charitable strategies and different things that we can invest in from that standpoint to help on a tax standpoint. Oil and gas. This is a big one that we use this year, especially for different tax planning around income tax brackets. And oil and gas is a fun one that we say, instead of going out and buying a vehicle, maybe put that money into oil and gas and get a very similar type of tax break or tax benefit. A lot of different advanced type strategies that we can talk about. The biggest thing with advanced strategies is we need to understand the strategy, and we need to make sure we're dotting our I's and crossing our T's and doing it correctly. This is taking advantage of all the different things within the tax code, but we need to make sure we're doing all of these strategies correctly. So if the IRS comes knocking, we have nothing to worry about because we know that we have done it correctly. And that's with any strategy that we talk about. Finally, I want to talk about bookkeeping. Bookkeeping is something that so many business owners don't think they need, or they get behind on it and they rush and they make mistakes, they lose out on opportunities. Now is a great time. We're not in tax season. You don't have to provide this to your accountant right away to file your taxes. Now's a great time. If you're not caught up on your bookkeeping, do that now. Take the time now to get your bookkeeping caught up, and then get on a regular cadence where you're doing it every week, every other week, once a month, whatever it might be for your business size, but you're on a regular cadence so that you're making sure that you're staying on top of those things. You have complete and accurate bookkeeping that you're not making mistakes. You're not rushing on, because you know what? You know how many bookkeeping files, and back in my days as a tax preparer, how many bookkeeping files that I could see that were just rushed and piled together? And what happens was, is they made mistakes. They made mistakes that cost them interest and penalties and tax issues. They made mistakes where they cost them paying too much in taxes because they weren't taking advantage of some of the things that they knew they could, but they just were in such a rush. So take some time now to get some of that bookkeeping caught up. And if you don't have any bookkeeping done or nothing at that point, let this be your reminder to start that action now. Look, tax savings don't happen by accident. They happen because business owners like you take intentional steps at the right time. And mid-year is that time to start making those steps. If any of these strategies made you pause and think, I haven't done that yet, or I haven't thought about that yet, now is the time to act. Don't wait until December, because guess what? Once 12/31 hits, all of these strategies, a lot of these strategies get thrown out the door. And if you're rushing, you're gonna miss out on opportunities that are readily available to you. Subscribe to us or hit that like button for more proactive strategies that you can implement before it's too late. That's my mission. That's what I'm here to do. And if you want a deeper dive on how to legally and ethically pay the least amount of taxes legally possible, along with assistance and guidance on how to completely and accurately implement those strategies, check out TaxElm. You can book a complimentary discovery call with our team via the link in the description. Thank you for listening. Here's to tax savings. Here's to being proactive and getting on top of those tax savings. And I will see you on the next one.